This is the worst trading day for stock markets in nearly 2 years.
Today, we need to discuss something critical. The stock market is in a nosedive. The Dow has plummeted over 1,000 points. Japan's market experienced its worst day since 1987, and recession fears are intensifying. This situation demands immediate attention. Let's explore what's happening, why the stock market has taken such a hit, and what it means for everyone. If you find this information valuable, please hit the like button and subscribe to the channel. It really helps us continue bringing you important updates. Let's dive in. Current market turmoil. For the first time since 2020, we're witnessing a perfect storm of events causing significant single-day losses. Here's a breakdown of the situation. The Japanese yen is unwinding, but don't worry, we'll explain what that means in simple terms. When we say the yen is unwinding, we mean that traders and investors are selling off assets denominated in yen to cover their positions, leading to a strengthening of the yen and a corresponding weakening of other currencies, including the US dollar. Global economic connections. Global economies are highly interconnected. Changes in one country can ripple across the world. For instance, economic shifts in the UK can affect the US, and decisions in China can influence our markets. Right now, money is shifting around because some economies are stronger than others. Despite the US dollar losing value over the past 50 years, it remains the world's reserve currency, meaning there's always demand for it, especially for US treasuries. This interconnectedness means that a financial event in one country can quickly spread to others, causing global market volatility. Understanding the Japanese yen and US treasuries. Each country has its own currency, interest rate, and inflation rate, often measured against the US dollar. This creates opportunities for arbitrage, where one can borrow money in one currency at a low interest rate, invest it in another at a higher rate, and profit from the difference. For over 30 years, Japan has struggled with deflation, an aging population, and low demand, which has kept their interest rates very low to encourage spending and borrowing. To understand the recent changes, it's important to look at the historical context. Japan's economy has been in a state of stagnation for decades. The burst of the asset price bubble in the early 1990s led to a prolonged period of deflation and economic stagnation. The Bank of Japan adopted a policy of very low interest rates to stimulate the economy, but this led to other issues such as an aging population and a shrinking workforce. Despite these challenges, Japan remained a major global economic player. Recently, the US faced record-high inflation, leading to rapid interest rate hikes, making US investments more attractive. Traders borrowed Japanese yen at low rates, converted it to US dollars, and invested in higher-yielding US treasuries. As the yen weakened, this strategy became very profitable. However, Japan's recent interest rate hike changed everything. The yen strengthened, the dollar declined, and traders suddenly faced significant losses when paying back their loans. On July 10th, one US dollar was worth 161 yen. After Japan's rate hike, it dropped to 143 yen, a 10% decline. This caused massive sell-offs as traders moved their money to cover their losses. Japan's market experienced its biggest single-day loss since 1987, and this panic spread globally. This illustrates how interconnected global markets are, and how a policy change in one country can have far-reaching effects. Why did Japan raise rates? Japan had to raise rates to combat inflation. When their currency loses value, it costs more to buy goods from other countries. So, they raised interest rates to stabilize their currency. But this caused a ripple effect across global markets. Inflation has been a persistent issue globally, and central banks are struggling to balance growth and inflation. Japan's rate hike was a necessary step to control inflation, but had unintended consequences for global financial markets. Recession fears in the US. Adding to the chaos are growing fears of a recession. US companies are hiring less, the unemployment rate has risen to 4.3%, and there's a negative cycle of job losses, reduced consumer spending, and declining business revenues. Historically, when the unemployment rate rises by half a percentage point from a year ago, it's a strong recession indicator. This cyclical nature of the economy means that recessions are a natural part of economic cycles, but they can be challenging for individuals and businesses. Market reactions and Warren Buffett's moves. Oil prices dropped to $73 a barrel due to reduced demand fears affecting exporters. Warren Buffett recently sold nearly half of his Apple stock, raising $84 billion before the market downturn. His timing was impeccable, and he adjusted his investments just before major market shifts. Buffett's moves often signal broader market trends, and his recent actions suggest that he anticipates further market volatility. What's next for interest rates? Some economists are calling for the Federal Reserve to cut rates to ease the situation, but historically, rate cuts often come when the economy is already in trouble. Since 1990, each time the Fed cut rates, the stock market initially declined due to underlying economic issues. Rate cuts can stimulate economic growth, but they also indicate that the economy is in trouble, which can initially cause market panic. Are we doomed? Not quite. Even with these challenges, markets do recover. Currently, the market is down less than 10% from recent highs, which is not unusual. On average, a 10% market correction happens every 16 months. While these drops can be scary, they are part of normal market cycles. Historically, markets have always recovered from downturns, and long-term investors typically see substantial gains over time. Tips to stay prepared. Here are some practical tips to weather this storm. 1. Emergency fund. Keep a 3 to 6 month emergency fund. This prevents you from having to sell investments at a loss if you face income reduction or job loss. 2. Diversify. Spread your investments across different assets like cash, treasuries, index funds, real estate, and even cryptocurrencies to minimize risk. Diversification helps spread risk and can protect your portfolio from significant losses. 3. Consistent investing. Keep investing regularly, even during downturns. Markets historically recover and provide substantial returns over time. Dollar cost averaging can help mitigate the risk of market timing and ensure you buy low and sell high. 4. Avoid panic selling. Resist the urge to sell during market drops. Stay the course and focus on long-term gains. Panic selling often leads to realizing losses and missing out on subsequent market recoveries. 5. Maintain steady income. Ensure a steady income to continue investing and avoid selling assets during tough times. A stable income allows you to maintain your investment strategy and weather economic downturns. 6. Extra cash. Keep some extra cash on hand for peace of mind. It's not about maximizing returns but being prepared for unexpected events. Having cash reserves can provide liquidity and help you take advantage of market opportunities. 7. Short-term needs. If you need the money in the next 3 to 5 years, consider safer investments, since the stock market can be volatile in the short term. Short-term needs should be met with less volatile, more liquid investments to avoid selling during a downturn. Conclusion. What to expect. The market will eventually recover, but it's a roller coaster with ups and downs. Stay informed, be patient, and make smart financial decisions. Let's continue this conversation in the comments. If you found this video helpful, please hit the like button and subscribe. Your support means the world to us and helps us keep bringing you important updates. Thanks for watching, and until next time.